Good afternoon, everybody. Thank you again for joining us on our third webinar in reference to COVID-19. First and foremost, I want to wish everybody, hope everybody's safe, their families, yourselves. I know it's been a tough. Oh yeah, if everybody can please make sure their phones are muted, we'd appreciate it. Okay. Sorry about that. So first of all, we want to make sure everybody's health, his health is being, is safe and so forth. These are definitely some trying times, and I know we're all busy and trying to do what we can to keep our businesses up and running. I'm going to go ahead and now introduce Carlos again, Zumpano, and Kelly Cueto, who have been instrumental during this time for us, and really truly appreciate everything they've done to keep us all informed of the many changes that keep on happening. If any questions come up, please, feel free to use the chat. I know at the end, as always, we'll have a question and answer session. I can assure you, though, that your Regis team is doing everything possible to make sure that, from our end, we are all set to send whatever information the banks and the SBA require for you when you apply for these loans. So with that being said, again, thank you all for joining the call. And I now leave it to Carlos and Kelly to take over. Thank you, Carlos and Kelly.
Thank you, Carlos Rodriguez. And again, thank you all for attending. It's an honor to be here. And we really appreciate the opportunity. This is the third webinar during this coronavirus crisis. And I'm really pleased with the interaction amongst all of us. And I hope you get something really valuable out of today. Today, Kelly Cueto and I are going to take you through the CARES Act and some important highlighted points. Prior to getting into that, I wanted again to thank Regis for their leadership in this process. These are trying times. A lot of information is being thrown out there to the public. A lot of information concerning, as you know, expanded FMLA leave, paid sick leave, which were the subjects of the first two webinars. And now there's been an approved stimulus package, which is a third subject. So it's a lot for businesses to digest in a short period of time. And I commend Carlos Rodriguez and the entire Regis HR team for being so proactive and reaching out to all of you. So let's begin. Having said that, let's begin with the CARES Act. So what we're going to go through today is to try and explain to you all in as simple terms as we can, more from a big picture standpoint, what the CARES Act is attempting to achieve here, as well as the economic relief that they're attempting to provide for small businesses and so forth. Obviously, there is a lot of nitty-gritty details that you should consult with your CPAs and tax consultants. They're going to be key here, because as you will see today, there are a few options that you can take that might be more beneficial to you. One option may be better than the other, and that's where working with your CPAs and your accounting professionals will be very, very helpful in implementing that. What we're doing today is to give you the tool, the broad brush overview, which could help you engage in more of those detailed discussions with your CPA, tax advisors, and even legal consultants. And what we expect in the coming days and in the real short term is some more regulations that come out to flesh out what the CARES Act attempts to provide to small business owners. There's a lot of questions out there. We hope to answer most of them now, but don't be surprised if there's a lot of clarification coming out in the next hours and days as to how banks will be implementing this and guidance on the CARES Act itself. What we're going to do in this presentation is divide this up into 8 sections. The first two, of course, are a brief overview. The CARES Act overview, Keeping Workers Paid and Employed Act, Paycheck Protection Program. All of these issues are going to be focusing in the beginning on those loans that have forgivable components, which many of you have heard about, which is extremely attractive to a lot of small businesses. While we go through those forgivable loans, those potentially forgivable loans, we'll get into we'll transition into some loan relief for larger businesses. We're also going to get into some expanded employment benefits, unemployment benefits, but other employment-related advantages for small businesses that we'll speak to there. Some of those are the programs I spoke about earlier that involves deferrals on specific payroll taxes, employee retention credits, and so forth, basically tax credits and tax holidays. And those are the situations where you need to look from an internal corporate perspective, business perspective, as to which of the two, the paycheck forgiveness program, the loan forgiveness program, or those credits are more advantageous to you. And we'll conclude with some updates to the FFCRA, the expanded FMLA leave, as well as the expanded paid sick leave, which were the subject of the first two webinars. There have been some changes as part of this latest stimulus bill that will affect that. I'll end up doing the first half and Kelly will do the second half. We will conclude with a question and answer session at the end, and we're here as long as you all need, and Regis needs us to help out get through this presentation. Okay. CARES Act overview. This was signed into law on March 27th, 2002. As you know, the House passed it first, the Senate passed it. Sorry, the Senate passed it first, the House approved it, and then that same day on March 27th, the President signed it into law. What we're going to do is highlighting important big picture practical implications. There are numerous, it's an 880-page document. There are numerous other provisions in the act itself, may not be so relevant to you, which includes stimulus for large, big businesses, such as airline industry and so forth, that are not applicable here, among other provisions. What we're trying to accomplish here is a compact, big picture assessment to see how much of this may impact you as a small to medium-sized business. Okay, so the CARES Act, one of the most exciting things that the federal government is doing is enabling small and medium-sized businesses to receive federal loans to cover payroll costs as defined in the act. And we'll get into that definition. It's for an 8-week period. The monies from the loan are to be used specifically during that 8-week period. And they need to be used for specific purposes in order to be forgiven. And as we will get into below, banks are going to be, and credit unions that are approved by the SBA and the government are going to be administering these loans. It's meant to be a quick process. It's meant to be fluid, and it's meant to put liquidity into the markets and into the small and medium-sized businesses in order to keep those businesses employing its current employees. We'll get into how some of the scenarios that may occur in the next 8 weeks with downsizing or upsizing might affect the forgiveness. But in short, what the purpose of these loans are to make it easy on businesses to survive during these trying times. And it's meant for an 8-week period subsequent to taking out the loan. The employment developments in this act also include a significant expansion funding of unemployment compensation, which Kelly will get into, and Kelly will also get into changes, clarifications to paid leave under the Families First Coronavirus Response Act, which was, as I stated earlier, the subject of the first 2 webinars that we've done. The Keeping Workers Paid and Employed Act. Now we're going to get into the loan program. We're going to start with that one because that is the one that many businesses will actually likely take advantage of as opposed to some of the other tax credits. It's the most, right now, it's probably one of the more talked about and exciting programs, and they involve with potentially forgivable loans. The purpose of it is designed to keep workers from losing their jobs and maintaining the small businesses due to the coronavirus pandemic. It's cash flow, federally guaranteed loans to employers who maintain their payroll during the coronavirus crisis. Down the road in this presentation, we're going to get into a situation where an employer, even during that 8-week period, cannot maintain their payroll or their staff, and we'll let you know what ramifications that has in terms of forgiveness of loans, but we'll get to that below. But the purpose of this is at least try and keep the status quo. Try and keep your payrolls full, including the employment's full. And it's a approximate $350 billion loan program for qualifying small businesses. They are to be immediately available through Small Business Administration certified and approved lenders, which includes banks, credit unions, and other financial institutions, and other lenders approved by the SBA. They are going to be the administrators. Those banks will quickly give you a list of documents that they need and information. They will process the application. They're expected to fund quickly because it's going to be federally funded. And they will also be the administrator to deal with the forgiveness, which will come later, the forgiveness potential, which comes after the 8-week use. So the loans will assist applicants, small businesses, in covering 4 main areas. The loans will assist applicants in covering payroll, rent, utility payments, and other specific defined obligations that we'll get into. They can be forgiven if they're used for the specific purposes. So the purpose is, once we get to the formula and how the loan comes out, what's going to be important from a practical standpoint is that small businesses are set up to earmark the use of those proceeds for 4 main categories. The good news is those 4 main categories are a very big part of what a business needs to operate from a basic. There are going to be other expenses during this time, but they are the core 4 main aspects of operational costs. Now, for purposes of the IRS code, any amount which would be includable in gross income of the eligible recipient by reason of forgiveness shall be excluded from gross income. No application fees, no closing costs. Loans are non-recourse, no personal guarantees, no collateral requirements. When in your lifetime will you ever have the ability to get a loan with all of those requirements laid out? It's frankly unbelievable. And it's an extremely business favorable scenario. Let's get into these loan programs. They are applicable to businesses with less than 500 employees as defined in the Act. The coverage period is from February 15th, 2020 and ending on June 30th, 2020. Lenders will be looking to see that you were in business as of February 15th. This date of February 15th will be key. As you see when we get down below, when we deal with forgiveness, it'll have that February 15th date pop up, especially when we start talking about lease obligations and so forth. What costs are covered? So as part of the loan. When you apply for a loan, you're going to be coming up against the formula. These are categories that you want to start looking into from a financial perspective as a small business. It's a little bit more detailed in the Act, but we tried to summarize it here. But what are the costs that are covered by these loans and that go into that are going to help you deal with a calculation of the amount that's going to be lent? Wages, commissions, tips, PTO, including paid sick leave, severance or separation pay, payments for group health benefits, including premiums, payment of retirement benefits, payment of state or local tax assessed on compensation of employees, not federal, not FUTA, state or local tax, and the sum of payments of any compensation to or income of a sole proprietor or independent contractor that is a wage, commission income, net earnings from self-employment or similar compensation, and that it is an amount not more than $100,000 per year in 1 year as prorated for the covered period. You will likely be hearing more in the guidelines as to how companies can claim on behalf of independent contractors and K-1s. There's a bit of fleshing out that needs to be done and guidance, and you'll see some conflicting reports out there. But the way it's drafted, these are included as part of the covered cost. But you will see there will likely be some more guidance on dealing with the specific contractor and K-1 type issue, self-employed issue. Okay, what is not covered for purposes of the loan calculation? Compensation of an individual employee in excess of an annual salary of $100,000. So if you've got somebody making $150,000, for purposes of determining the loan amount as well as forgiveness of loan, we'll get to that down below, you're capped at $100,000 in calculating the amount. So if somebody makes $150,000, the bank is only going to look as if that individual makes $100,000 in total compensation. Taxes imposed or withheld under Chapter 21, railroad tax. So that's FICA. FICA is not included. Federal income tax of the Internal Revenue Code during the covered period. Any compensation of an employee whose principal place of residence is outside of the United States, not surprising, because what they're trying to do is keep people employed and working in the United States. Qualified sick leave wages and qualified family leave wages for which a credit is allowed under the FFCRA, subject of our first two webinars, and in which we will conclude today on some modifications. Okay, big question, as before we get into calculating the amount of the loans and the forgiveness and all that. Question has come up, are sole proprietors, independent contractors, and eligible self-employed individuals covered? The answer is yes. Eligible self-employed individuals, independent contractors, sole proprietors may seek a loan, and they're required to submit documentation to show that they qualify. Payroll tax filings, Form 1099 miscellaneous, and income and expenses from the entity. Are franchises eligible? They must meet certain criteria. So normal affiliation rules do not apply with franchises, so they are treated here in a more special manner. Also, you'll see that certain franchises that have less than 500 employees at one location may qualify if they have multiple locations with less than 500. So you may have one location with 499, another location with 499. You're over the 500, but you still qualify. But you must be an NICS, CNAICS 72 category, which, as we will get into, deals with more hospitality, hotels, restaurants, and accommodations. Check with counsel. It's important to determine if you're eligible. These rules have specific nuances. So as I just stated, are businesses with more than one physical location covered? Yes, in part, only if you qualify under that NAICS, North American Industry Classification System Code 72. which deals with accommodation and food service establishments, as I stated, hotels, restaurants. Those, you may have multiple locations shy of 500 that still qualify, but it's limited to those areas. If you're not in NAICS 72, then no, you're likely going to be in that less than 500 unless there's a specific exception. And one thing to keep in mind, if you're a seasonal employer, throughout this entire presentation, there may be specific rules that apply to you if you're seasonal. Okay, this is a big part of discussion going on. How much are the loan amounts for? Well, there's a formula, and they've given a very clear guidance on what the formula should be. During the covered period, with respect to a covered loan, the maximum amount shall be the lesser of 2.5 times the average monthly payroll costs. Or 10 million. The payroll cost is calculated from the 1 year period prior to the date the loan is made. So if you get a loan from April 15th, on April 15th, you calculate the average monthly payroll cost for the prior 12 months. You're going to multiply that. So if it's $100,000 a month during the prior 12 months on an average payroll cost, the loan amount is $250,000, 2.5 times that. If you get $5 million average monthly payroll, the loan amount is not $15 million, which would normally be 2.5 times. It's capped at $10 million. Seasonal employers have a different assessment. The average monthly payroll cost is based on 12-week period beginning February 15, 2019, or March 1st, 2019, up until June 30th. You get to elect that 12-week period within that period of time. Certain loans made during the period beginning on January 31st, 2020, and ending on the date in which covered loans are made available may be refinanced as part of a covered loan. So check with your tax and accounting advisor as to whether any existing loans may be refinanced as part of this. So when you calculate the 2.5 times, the 250% of the 1 month, what's included in what's allowable, once you get that number, what are the allowable uses for that? Okay, 4 main categories. Payroll costs, same definition that we stated earlier. Remember, for employees and contractors, capped at $100,000. That's the first category. Payroll costs, same definition for getting the loan, same definition for allowable uses for the loan. 2, payments of interest on a mortgage obligation. Does not include prepayment or payment of principal on a mortgage obligation. 3, rent, including rent under a lease agreement or lease costs. Utilities, and interest incurred before the covered period, February 15th, on any other debt obligations. Certain loans made during the period beginning on January 31st, 2020, and ending on the date in which covered loans are made available may be refinanced, as we spoke earlier. So it's important that when you get this loan, from a big picture practical standpoint, say you get $250,000, you're going to have 8 weeks to use it. Even though you get $250,000, which is basically 2.5 times your normal payroll cost, you're only going to get 8 weeks, which could be less than 2 months to use it in order to be able to qualify for allowable uses of the loan. Before we get into the loan forgiveness issues, which are very important, this section gets into, are there any credit standings, collateral, personal guarantee requirements? The answer is no. A lender will consider whether you were in operation on February 15th and had employees from which you paid salaries and payroll taxes, or paid independent contractors, as reported on a Form 1099. During the covered period, the requirement that a small business concern is unable to obtain credit elsewhere shall not apply to a covered loan. That's amazing. So if you're struggling on getting a loan from a bank as you speak now, that goes out the window. The government is saying, welcome. You're qualified for that, assuming you meet these other basic qualifications. No personal guarantees or collateral, as stated earlier. Notwithstanding the waiver of the personal guarantee or collateral, the SBA shall have no recourse against an individual shareholder, member, or partner of an eligible recipient of a covered loan for non-payment of any covered loan, except to the extent that such shareholder or member or partner uses the covered loan proceeds for a purpose not authorized as an allowable use. So the key here is no bad acts. You take the money, you do your best to use it for the specific allowed purposes. Don't use it for personal use. You want to stay within these parameters of use to preserve your and no bad acts, to preserve the no guarantee, no collateral, non-recourse, which is an amazing benefit for any loan. Okay, before we get into the forgiveness, I know that's coming because that's going to be an important part of this conversation. A big issue is, do loan applications require certification? When you deal with banks, you are probably already getting emails from banks asking for documentation. They're asking for documentation. Of course, it's a little bit further than what's in the act already, but it's not surprising. We'll get into some of the stuff that they're asking for in a second. But what the act is asking you to do is to make a good faith certification of these 3 bullet points. 1, that because of the uncertainty of these situations, this loan that you're seeking is to support the ongoing operations of you as an eligible recipient, acknowledging the funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments. So you're making a certification that you're going to operate in good faith, to use it for the purpose for which this is set out to, and it's to help keep your team together. The eligible recipient does not have an application pending for a loan for the same purpose and duplicative of amounts applied for, received, or recovered loans. So you don't want to double dip. What the government is saying, this loan is for this specific reason. It's to help you maintain your payroll, help you maintain during these trying times, during this 8-week period. If you have another loan for that same purpose, that's a problem. During the period beginning on February 15th and ending on December 31st, 2020, that you have not received amounts for the same purpose and duplicative amounts applied for or received under the loan. So it's one is you don't have an application pending, and the other one is you don't receive monies. So there will be a certification. So what are banks requiring? The reason we kept this very short is that you're going to see banks come out now a little bit lost as to what they're trying to do is gain your business. So they're throwing out this laundry list. It may stay that way. It may be that the list you're receiving from banks now, which you may have seen include financial statements, specific tax returns, payroll information, 1099s, things like that. They'll ask you for all that. That may or may not change depending on what the regs come out in the coming days.
Hey, Carlos.
You will already start seeing banks come out with information.
Carlos.
Yes.
This is Carlos again. Now you're talking about the bank information. I just received an email from our national association. Sure. And I think it'd be a good time to add to just, I'm going to read this quickly, hopefully not too quickly. But let me just tell you what they wrote us.
Good.
And many of you have reached out with questions about the PPP. That is part of the CARES Act. This is what we know. The Treasury Department and Small Business Administration are working this week on promulgating the regulations that will guide the program. They are expected to be done Thursday, likely late in the day. Treasury Secretary Steve Mnuchin said yesterday, these loans will be available starting on Friday, which will be at lightning speed. To be clear, no one is applying for the PPP loans right now because it is not possible. The programs do not yet exist operationally. There are no forms on the SBA site. Some confusion may lie in the fact that there is an economic injury disaster loan, EIDL, from the SBA that have been around for years. However, the EIDL loans are different from the PPP loans under the CARES Act, most notably in that the EIDL loans do not have the PPP's loan forgiveness rules. Okay, so very important. If you have clients that have already applied for or received EIDL loans, they will be able to refinance the EIDL into the PPP for loan forgiveness purposes. However, they may not take out the EIDL and PPP loan at the same time and for the same purpose. Okay, so just to give you guys a little bit of understanding where the government is and working through this. The other thing that I want to just mention quickly is I spoke to a friend of mine, CPA firm, client/friend of ours, and he mentioned that one of his clients' banks was even asking for 12 months forecast, okay, in addition to everything we've seen so far. So I think Carlos is right in saying that I think, banks are maybe being proactive / trying to get your business, etc. I think we got a little bit careful on what they're asking for. That's one of the things I haven't seen anywhere. But the fact that a bank asks for a 12-month forecast, the main purpose of this loan was supposed to be an easy loan to apply for, easy to get. And then the idea was that when it came down for forgiveness of the loan, that's when they were going to ask you for a lot of paperwork. So again, let's just be clear. I know there's a lot of stuff going around, a lot of information that we think we need, but the guidance is still not out as to what is being required. And I hope for all of our sakes that it's a standard across the board and not that the banks will individually kind of pick and choose what they want to ask for. If it is, then we got to deal with it. But I'm hoping it's a standardized package. Every bank asks for the same thing and we move forward. The fact that one bank was asking a client for 12 months forecast scared me a little bit. But again, I think banks are just trying to be proactive and trying to, develop the relationship with the client. But again, I don't think we'll have a set answer until this comes out. I've also heard, I just read to you that they believe it'll be ready Friday. I've heard through other sources that that's a dream or a pipeline wish. But I guess we'll see and hope that by next week we can start applying for these loans and start receiving the money next week. But we'll have to see. Thank you, Carlos.
No, thank you, Carlos. And before we start again, if we're hearing a lot of noise. If everybody could mute their phone, that would be great. Their audio, I mean.
Hey,
all right,
Carlos, it's Kelly. Do you mind if I jump in for a second?
Go ahead, Kelly. Go ahead.
Thanks. On the previous slide, one of the requirements or the certifications that borrowers need to make is that they have not applied for a duplicative loan, right? And so one of the things that we're seeing over and over again in the guidance, and kind of to Carlos Saladrigas's point as well, in terms of a simplification or an across the board simple one type application for every bank or every lender, it goes to this point because think about getting loans or other financing options. A lot of times what a savvy borrower will do is fill out applications with multiple lenders and then go with the one that provides them with the best loan package. This is supposed to be a standard loan based on the information that you provide. So you can't shop around, so to speak. So that kind of reinforces what Carlos was saying in terms of, the hope is that there's going to be one standard application because you are going to be required to certify that you haven't applied for this loan from multiple places. You can only apply one place.
Agreed. Thank you, Kelly. The other thing that's important to know is right now, the reason that you're getting a lot of emails, let's think of this big picture. The banks are going to make money from this. They are able to charge a specific percentage based on the size of the loan, which is fine because they're administering and they should get charged on this. But they will make money on this. So it's not surprising that we're getting inundated with competitive emails saying, get out there first with us and get out there to do this. The government wants this to be for the small business, not for the banks. This is not for profit taking from the banks. It's meant to benefit the small business. So you're going to see a lot of guidance come out in the coming days. Steve Mnuchin had said a while back he expected to get it done by Friday. I agree with Carlos. That may happen. I think that's incredible if it does. If it doesn't happen, it wouldn't surprise us. But we're all hoping that we get more guidance today, tomorrow, in the coming days this week. But we will see where it goes. There's a few unanswered questions that need to be done, and hopefully they will provide that. That's why we kept this page simple. Don't think that what the banks are sending you right now are going to be what's final in the end. What is the maturity date of loans and interest for unforgivable loans? Great question. For all of you who are going to be dealing with this going forward. If you're a covered loan, the remaining balance continues to be guaranteed by the administration, and the covered loans it will convert into a 10 years from the date of this with an interest rate not to exceed 4%. So you're going to have a situation where you're going to get forgiven, or the loan, you're going to get completely forgiven, and we'll go into how that forgiveness process will work, or a part or all of it, if it's not used for what you're supposed to be using it for, will convert into a 10-year loan with a maximum interest rate not to exceed 4%. During the covered period, the administration also considers an eligible recipient that applies for a covered loan to be an impacted borrower and requires lenders, this is interesting, to give you a deferment relief to provide complete payment for impacted borrowers for covered loans. can't be less than 6 months, this deferment relief, and that includes payment of principal, interest, and fees, and not more than 1 year. So if for some reason part of this loan gets excluded from the forgiveness, it converts into a 10-year loan up to a maximum of 4% interest a year, and there's a deferment relief aspect to that loan, which is very, very favorable. Okay, now we're going to get into an important part, which is the forgivable component of the loans. If you're an eligible recipient, you shall be eligible for forgiveness. You can apply for forgiveness for any amount equal to the sum of the following 4 costs. We had spoken about this earlier as to what the purpose of the loan is for. Same 4 purposes are for purposes of forgiveness. Use the loan as it's intended for, forgiveness as it's originally intended to be used. You have to use them during the 8-week period after the origination of the loan. They are costs that you pay after the origination of the loan. They involve payroll costs as defined above. Same consistent definition. It's payroll cost. That's number 1. We spoke earlier, payment on interest on any covered mortgage obligation. Now, this is important. Generally, this interest on this debt had to have been incurred on real or personal property before February 15th, 2020. You recall earlier in the presentation, in the webinar, February 15th was a key date. For purposes of interest, it had to have been incurred on real or personal property before February 15th. Remember, the forgiveness does not include using that money to pay down the principal component or the repayment, prepayment, or repayment of or principal on a debt. It's the interest payment for loans incurred on real or personal property before February 15th. Any payment on any covered rent obligation. Now that has to have, in order for it to be a covered rent obligation, again, it needs to be a lease in effect before February 15th, 2020. What they don't want are these lease obligations, these loan obligations popping up on April 15th and say, oh, I'm going to use it for that. It's supposed to keep things retained, employees, business operations moving forward, get through this crisis, and these are existing obligations. Any covered utility payment, this is the 4th category, which are generally for utility payments for services, which began before, again, February 15th, 2020. You recall we referenced this, that's the covered period initially February 15th and beyond. Are there limits on the amount of forgiveness? Now we're going to get into what limitations you have on the forgiveness, such as if you get a $250,000 loan, how does the administrator, the bank, because they're going to be the one determining forgiveness, how do they calculate whether you get 100% of it forgiven or whether you get a fraction of that forgiven? Well, going back to the purpose of the CARES Act and what we're doing here, what the government wants you to do is to limit your reduction of employees and your reduction of salary and wages during the covered period. Covered period meaning the 8-week period. So there's going to be 2 circumstances, 2 key circumstances. Assuming you're not dealing with fraud or inappropriate use, the government is looking for 2 circumstances to reduce the forgiveness. There's going to be a fraction that's going to be, we're going to get into that now, that's going to be multiplied by the maximum forgivable amount, and it's going to be based on the reduction of employees. We'll get that into it. The other one is reduction in salaries. What they're trying to do, retain your staff, retain your salaries and wages, if possible. If you can't, then there's a formula we'll get into now. Additional wages provided to tipped employees and wages provided to employees rehired during the period beginning on February 15th, 2020, and ending on the date that is 30 days after the date of the enactment of this act, which was March 27th, may also be subject to forgiveness. So tipped employees and rehires have an additional circumstance that will allow forgiveness. Okay, let's get into the calculation. How do you calculate the maximum amount of forgiveness? There are 2 scenarios. One is going to be lowering the number of employees, and the other one is going to be lowering their salary or wages. So let's start with lowering the number of employees. What it says is you're going to take your maximal amount of loan, $250,000. You're going to multiply that. Now we're dealing with the scenario of only reducing your staff. You're going to multiply that by a fraction, the numerator of which is the average number of full-time equivalent employees per month calculated during the covered period. That is the 8-week period. Down below, I have the definitions. Divided by the denominator, of which is the average number of full-time equivalent employees per month calculated during the choice period. That's it. That's the formula for reduction only in staff. What's the choice period? Down below, the borrower, the small business, gets to choose February 15th, 2019 to June 30th, 2019, or January 1st, 2020 to February 29th, 2020. Whichever one of the two works for you better will be used for purposes of calculating the average number of full-time employees for the denominator. So simply put, average number of full-time equivalent employees during the 8-week period divided by the average number of full-time equivalent employees per month on both the numerator and denominator during the choice period, the one you choose. That fraction is multiplied by the 250,000 or whatever your loan amount is, and then that's how the bank will calculate a reduction. If it's 1/1, you get full forgiveness. If it's 0.9/1, then as you can see, 90% of a loan would be forgiven. Take the other scenario. They're not mutually exclusive. They can reduce the maximum forgivable amount in both scenarios. You reduce pay, total salary or wages. This one works as follows. If you reduce during the 8-week period, the covered period, an amount that is in excess of 25% of the total salary or wages of the employee during the most recent full quarter during which the employee was employed before the covered period, only the excess beyond 25% gets reduced. So if you have somebody that makes $4,000 a month and you reduce their salary to $2,500 a month, when you compare it to the previous quarter, you reduce it during the covered period. The first $10,000 reduction, which is 25%, does not reduce your forgiveness. It's the extra 500, I'm sorry, I'm talking about 4,000. The extra 500 that does reduce your forgiveness amount, your forgivable amount. So let's repeat that. If somebody makes during the covered period $4,000 a month, and their salary is $4,000 a month during the previous quarter, and their salary is reduced during the covered period to $2,500, the first $1,000 reduction does not reduce your forgivable amount. It's the remaining $500 that does. It's the amount beyond 25% reduction. B, which is the reduction in the forgivable amount based on reduction in salary or wages, does not apply to those making greater than $100,000 annualized rate of pay. It is applicable to employees who did not receive during any single pay period during 2019, and the key year is 2019, wages or salaries at an annualized rate of pay in an amount more than $100,000. So when you do this, B, if you reduce salaries, you got to look at the worker and see if that employee was making less than $100,000 in 2019. If they were, and you reduce them during the 8-week period, then they may be subject to an amount that reduces the forgivable amount. Seasonal employees have specific provisions. All right, so in recap, look at your total amount. You're going to go for 100% of it. You keep everybody the same, and you don't change their salaries. You don't reduce their pay. The goal is 1/1 minus 0. If you do reduce the employee staff by a certain number amount, check the fraction. If you reduce the pay, check B, which is the reduction of a salary and wages in excess of 25%, and see if they qualify. All right. An eligible recipient seeking loan forgiveness shall submit to the lender that is servicing the application an application for forgiveness. Now, what's going to be key here is the lender that gives you the loan is the same entity that's going to decide the forgiveness of the loan. And they're going to ask for documentation verifying the number of full-time equivalent employees on payroll and pay rates for the covered 8-week period. And they're going to ask for ABC, payroll tax filings, income, payroll, and employment insurance filings, documentation including paycheck receipts, transcripts, mortgage obligations, lease payments, and utility payments. They're going to be focusing on whether or not you paid during the 8-week period those 4 categories that we had talked about earlier that qualify for forgiveness. It is not surprising that the documentation the bank will want in the phase of forgiveness, of the forgiveness application, is going to be a little bit more fleshed out, because they're going to be assessing whether or not you properly used it for the purposes that it was intended. You can also have a certification that the document you're presenting is true and correct. The amount of forgiveness requested was used to retain employees, make interest payments on a mortgage obligation, make payments on a rent obligation, or make utility payments, and any other documents the administrator determines necessary. So that you're going to be certifying that the documentation is correct and that you use the money for the amount that for the loan, that for the proceeds, for the intended purpose, so that you can get forgiven. So the banks will work with you right after the 8-week period that you make your application. Now, how and when will the loan forgiveness decision be made? Well, the government's saying we're not going to keep the small businesses up in the air forever. They've got 60 days after the date on which a lender receives an application for loan forgiveness from an eligible recipient to make a decision on the application. So this is meant to be a quick 8-week in and out, and a quick decision, no more than 60 days, approximately 2 months, on how much will be forgiven. Now, moving on. So that is the forgivable loans for small businesses and business concerns as defined in the Act, and how that operates. Now, we're going to move on quickly. We're going to probably have more to get through on the forgivable loans in the question and answer session, but we're going to move on quickly to loan relief for larger businesses. This applies to businesses that are greater than the 500. They deal with companies that are 500 to 10,000 employees. These are mid-sized businesses under the Act. They are not eligible for the Paycheck Protection Loan. They're eligible for other loans under the Act, and there are certain required certifications for these qualified businesses, and we lay them out in those full bullet points, which include not outsourcing jobs for the term of the loan. It includes not abrogating, and for 2 years after repaying the loan. Details there are very, very clear. I understand that for most on this call, this would be inapplicable, but it's good reading to go through. These are loans that are not forgivable. They are regular loans that they are repayable loans, but they have specific criteria, and we lay those out for you in our bullet points. We're going to now get into the expanded unemployment benefits. Before we get into the revisions to the expanded FMLA, as well as the revisions of the paid sick leave, I'm going to turn it over to my colleague, Kelly Quaid.
Thanks, Carlos. And for all the folks on the phone, just so you're aware, we're all working in this remote environment these days. So while you hear me loud and clear, Carlos is actually controlling the slide presentation. So I may need to nudge him just to let you know what's going on our end. So from the expanded unemployment benefits piece, this is what we have been hearing about as this unemployment on steroids. So what do the benefits entail? Basically what the federal government has done is funded a $600 per week additional allowance for folks who are unemployed. And when I say additional, in addition to what the employees would ordinarily receive under their state unemployment guidelines. So it's for up to 39 weeks, which is longer than the typical 26-week limitation in most states. The CARES Act also authorizes up to an additional 13 weeks of emergency unemployment benefits for eligible employees who have exhausted the 39 weeks and still remain unemployed. Carlos, can you flip? Thanks. Who's eligible? Okay, so the eligibility here, because we anticipate that the states, if you'll recall, we talked about this, if you were able to attend the other webinars or able to view them either in the recorded format or paper format, the states administer unemployment based on their own states' rules that are based off of federal requirements. So we anticipate, and when I say we, it's a collective federal government who passed the bill, employment lawyers, employers, eligible employees, we collectively anticipate that state unemployment agencies are going to be extremely, extraordinarily overwhelmed by the numbers of people who are going to be claiming unemployment benefits all at once. If you've seen the numbers come out in the news, they're quite extraordinary. So the eligibility here is going to be via a self-certification process, at least for right now. That's how it's set up. It's individuals who are otherwise able and available to work, but who are unemployed or partially unemployed. So they've either had their hours cut or their pay cut, or they're unable to work for a variety of, or otherwise unable to work for a variety of COVID-19 related reasons. So that could be that they are self-quarantined, they themselves are ill, they are not able to work because they're home due to school closures, but they do not have the FFCRA benefits. Their work itself is closed, perhaps due to local restrictions on what businesses can operate. There's a variety of reasons. As long as it's COVID related, then if the person is unemployed or underemployed, they are eligible. So what are the benefits here? It includes, who in addition to those folks that may not ordinarily be covered by unemployment would be the self-employed individuals and independent contractors, the gig economy employees, which would be like Uber drivers, those who are seeking part-time employment, and those who would not otherwise have a sufficient work history to qualify, so long as they meet other qualifying reasons above. So ordinarily, those folks would not qualify for unemployment. If, again, they are impacted because of COVID-19 related reasons, then they do qualify for this benefit. Who does it not include? It does not include individuals who have the ability to telework with pay, so work from home with pay, or employees who are receiving the emergency paid sick leave or other paid leave benefits. There's also a big bucket of funding here, $100 million in funding for partial unemployment compensation programs. So what these are typically referred to as short-time compensation or work sharing programs. And these are programs that are set up, again, state-by-state basis, where employers need to register with the state agency on unemployment. And it's a three-part, I guess, if you count the employee, but two-part agreement here. The employer agrees that they're going to reduce an employee's hours instead of laying them off. And then the state, on the other side, they agree that where ordinarily the individual would not be entitled to unemployment benefits is going to provide them with a partial benefit. So certain states have this, not every state does, but there is in this package, the stimulus package, $100 million for funds that do not pay for the unemployment piece of it themselves, but rather it's allocated for the promotion of the program, the enrollment of employers into the program, and the implementation and improvement of the administration of the programs. In other words, $100 million to help them hire people, improve their infrastructure, and get these programs up and running, because of course the overall intent of all of this that we keep hearing about is to keep employees on the payroll and to keep money in their pockets so that they can continue to spend money and make the economy continue to move forward. So moving on to tax credits and tax holidays. So this is in red on the presentation on my end. I hope it's in red on the presentation on your end. I hate being one of those lawyers who gives you a million advisos and quid pro quo, or not quid pro quos, but that came out of I'm watching too many shows with my kids, and Aladdin popped into my head. But the all the different warnings, and you just don't want to hear it from the attorneys, how many different ways that we can tell you, be careful, don't do this without talking to an attorney. Well, be careful, don't do this without talking to your attorney, your CPA, your tax professional, your Regis rep. There are so many working parts here with the loans, with the FFCRA, with the unemployment, with the tax consequences. So big red box up here, talk to your tax advisor. But we will tell you a little bit about them. Carlos, can you flip? Carlos Z, can you flip this slide, please?
Yes, I have
There we
flipped.
go.
Does everybody
All right,
see the
so what's
page?
the tax credit that is provided here? So, whoa. Yeah, we're going to the next one. Sorry, you went back. You went forward, then backwards. There we go. The tax credit provides eligible recipients with a, we good? Oh, nope, we went back again.
There, we're on it.
Yep, Kelly, we're on it. It says tax credit at the top.
Okay, perfect. Sorry, it kept disappearing from my screen. Okay. Tax credit for eligible recipients. It's a refundable payroll tax credit for 50% of the wages paid by the employers during the COVID-19 crisis for wages between March 13th, 2020 and December 31st, 2020. The credit is available to employers whose business was fully or partially suspended as a result of a COVID-19 related shutdown order, or whose gross receipts declined by more than 50% in comparison to the same quarter the previous year. The application of the credit, as well as the limitations and refundability and other provisions, are addressed in further detail in a memo that we have sent to Regis for you all to read in more detail. But we strongly urge you to discuss these provisions with your CPA and tax provider. One thing is really important to note here is that this tax credit is not available to employers who receive the Paycheck Protection loans. So again, this is where we're telling you, you need to see how all the different pieces work together to figure out which option makes the most sense for you as a business.
Kelly, I'm just going to interject here. For those of you may have seen the memo, Regis is I believe posting it on their resources. It goes hand in hand with this presentation, and it talks about this tax credit a little bit more. This is one of those areas that I had stated at the beginning of this webinar that if you choose to go down the Paycheck Protection loan scenario, it doesn't allow, this is not available. We're going to get into now a payroll tax credit that is different and works a little bit differently, but it is excluded under certain circumstances if you have taken one of these potential forgivable loans. But this is an either or. It's not cumulative. You can't take the loan and also engage in that loan, the potential forgivable loan, and also take this tax credit. Sorry, Kelly, go ahead.
No, that's okay. Can you move to the next slide on the tax holiday? There we go. So this is a deferral, actually. So there's the tax credit, which is one thing, and then there's the tax holiday, which is completely separate. Employers may be able to defer the payment of their Social Security taxes due for the period of the beginning date of the enactment of the bill, which would be March 27th of 2020, through December 31st, 2020, under certain restrictions. But again, this deferment is not available to the employers that receive the Paycheck Protection loans. So there's tax credits, which we just talked about, and then this tax holiday, which is a deferral. Neither one of them can be used if you are receiving the loans. In terms of this tax holiday, it does need to be paid back. Whatever amounts you defer needs to be paid back within 2 years. 50% needs to be paid back by December 31st of 2021. And then the remaining 50% needs to be paid back by December 31st of 2022.
Kelly, I'm going to just interject here. The distinction between these two, this tax holiday, is if you participate in the loan program and there's an indebtedness forgiven, you can't benefit from this. So unlike,
right,
right. So it's interesting what the distinction with the tax holiday if you take part in this loan and you're able to get, forgiveness as a result of this, of the loans under the CARES Act, the forgivable loans, then this does not apply. So it's an interesting distinction between the tax holiday and the employee retention credit.
Okay, so the CARES Act also provided us with some clarifications to the FFCRA, the Families First Coronavirus Response Act. And if you'll recall, the Families First Coronavirus Response Act is what gave us the expanded FMLA and the emergency paid sick leave. So the first clarification that came out with respect to the FFCRA is the eligibility for expanded FMLA. What they wanted to make clear is that if you have laid off an employee and then rehired them, and they haven't yet made that 30-day payroll requirement for the expanded leave under the FFCRA, as they would have made that 30-day requirement prior to their layoff, and their layoff was after March 1st, they don't need to make that 30-day requirement again before they're eligible. So it sets it off. It sets it out here pretty clearly. So we just want to make sure that, or this clarifies that if you did lay off employees, you were concerned about making payroll or what have you, then you learned, oh, we've got this ability to put people on this expanded FMLA. What should we do? You can hire them back. They do not need to be on your payroll for 30 days before they're eligible, so long as, like I said, they were laid off after March 1st and they met the 30-day requirement before their layoff. Okay, next. So another piece, this was something that all we could tell you about was that Mnuchin was talking about it and was quoted in the Wall Street Journal as to how some of this stuff was going to work. And now some of this stuff has been discussed in more detail in the CARES Act. And this is with respect to what do we do with our Social Security tax deposits if the credit is going to be funding the expanded FMLA leave and the emergency paid sick leave. So what the CARES Act did is said that the employers can keep the money that they would have deposited for payroll taxes in anticipation of being refunded tax credits from the Treasury for paid sick leave and paid FMLA leave provided to the employees. The employers will not be penalized for withholding the deposits, and also that the IRS will be issuing additional guidance to help employers manage the process. As we stated before, and we will continue to state until we hear otherwise from the guidance that should be released soon, we believe this is just for the Social Security portion of the taxes. Okay, and then the next clarification came on the limitation on emergency paid sick leave. There were questions about the way the law was written. There were no limitations on it. It almost seemed like employees could be eligible for 80 hours over and over and over again. This places a restriction on that. So employers are only required to provide this emergency paid sick leave pursuant to the FFCRA. If you have different policies within your organization, obviously you have to follow your organization's policy in addition to the FFCRA leave, but only one time for each employee. So the obligation for the emergency paid sick leave with respect to each employee expires when the employer has paid the employee his leave, or when the employee has returned from work after taking the paid leave. So it just, that distinction there is just to make certain that for employers who perhaps pay in arrears, or their pay schedule is such that the employee returns to work before the paycheck is actually issued, there's not a lag there allowing the employee to take an additional leave during that lag time. Okay.
Thank you, Kelly. I appreciate it. Great work. In the end, we wanted to thank you all for letting us present today. A lot to cover here. There's a lot of questions and answers. I think the important thing to understand is that there may be changes. So check with your tax accounting consultants, your legal consultants. Obviously, Regis HR is there to provide support with it as they can and as they have been doing a wonderful job. But from here forward, at least we've got the core of what the Stimulus Act provides. And I suspect in the coming days, you'll be seeing more guidance come out
Carlos.
with some more details being fleshed out. So thank you again, Carlos Rodriguez and Regis. And I turn it over back to Carlos Rodriguez to see if he would like us to continue with a question and answer session.
Yeah, absolutely. I know we're going to be on the hour, but there's a lot of questions. So yes, absolutely. Definitely, if you guys can, I don't know if we'll get through all of them, but I saw some of the questions. There's some very good questions. Just really quick on a note, something else I'm going to read to you guys. I just received it from a bank of ours. It kind of scares me a little bit as far as the timeline. And this came straight from the bank. While we know a lot about the general framework, there are still details that are not yet known regarding applications, forms, and procedural processes. We expect to get the final details as well as the required forms and documentation from the SBA sometime between April 3rd and April 15th, which will allow us to start processing the applications. So again, we have no idea if this will be done at the end of this week, the beginning of next week, etc. So again, just FYI, it's a moving target, and obviously for all of our sakes, we hope that this comes out as soon as possible. But again, we're hearing different things as far as when this will be available. All right, Carlos, if you want, and Kelly, please, we can start answering as many questions as we can.
Sure, absolutely. Okay, so we're moving into the chat room now, and I'm going to be taking them in order. So we have a question. Do payments made to 1099 contractors forgiven like a bookkeeper, or would the 1099 contractor need to file their own application? Very, very good question. The way that the Act is written, we have seen a little bit of confusion on this issue, but the way that the Act is written, when you determine payroll cost, many are interpreting that as including your 1099s up to a maximum of $100,000. Some have asked, well, what if there are corporate 1099s? What if there are individual 1099s? The position that we have heard out there, and there's other seminars out there also, is that 1099s may very well be included for purposes of calculating the loan amount. And if you use it for the same purpose of it, it should be forgiven. There's nothing out there that would bar a contractor from applying them for themselves. However, we just got some materials from someone else that states that banks may be looking at sole proprietors and 1099s separately from the actual business making the application for the loan. There is literature out there, and you can see it on the internet now, that this is an issue that has been unresolved, that they feel there's confusion. We suspect there will be more guidance. Would not be surprised if banks, if corporations are able, and businesses are able to include their individual 1099s and potentially corporate 1099s based on a plain reading of the Act, but there may be a different interpretation, as there appears to be some out there that are reading it differently. So it's a subtle issue. It's a very, very good question. We just got bank materials, and guess what? The bank materials asked for the 1099s for the business, which gives you an implication that you would be able to use it to calculate your loan amount as well as your forgivable amount, because the forgivable amount is also tied identically to what the initial purpose of the loan amount was for. Payroll costs, although the payroll cost is only used, you only use payroll costs to calculate the amount if you use the same definition for the forgivable portion of payroll cost on the 4 criteria for forgiveness. So it looks as if the banks some banks are interpreting this as you can apply on behalf of your 1099s up to a maximum of 100,000. We hope, in light of some of the traffic that is out there, that they're a little confused, that it would be something that is clarified, especially with the language in the Act of not double dipping, and the intent is not to double dip. However, your contractors have their own business obligations too, and their own expenses. So you're seeing banks ask you for the 1099s because it looks like there may be an assumption you're going to be asking that for purposes of the over loan amount, but we're hoping there's more guidance on this as this comes out in the coming days. So I hope that's the best answer. Good question. It's an issue that we have been tackling and searching before this webinar. We're aware of it, and it just is, there's a bit of conflict out there, but a lot of people and even some banks now look like they're heading towards including it in your application for a loan amount, and that one component of payroll cost would be part of the forgivable component, because they apply the same definition. So wait for a few days, see what happens on guidance, but that's definitely going to be an issue of discussion because a lot of businesses have 1099. Okay, next question. Clarify, you can apply to the EIDL and the PPA, but not both, correct? Well, remember, there's going to be guidance on this, but one of the benefits of this program is they're allowing you to roll an existing loan that qualifies into this forgiveness program. Whether or not that applies will be determined. I believe Carlos Rodriguez had read a memo that addressed it earlier in the presentation. But our recommendation is there are loans that are meant for the same type of purpose that may be rolled into these forgivable loan scenarios. Check with your CPA, your financial advisor, as to the terms of your loan, how they're drafted, and whether or not they qualify to be rolled into the forgivable component here.
And that based on the memo I received and read earlier, the EIDL can be rolled into the PPP for forgiveness purposes. So that's the idea for sure.
And I think that's great. Carlos just got the latest and greatest guidance coming out, and I think you're going to see more in the coming hours and days. So that's excellent. Okay, 2 questions. I imagine there are no issues for utilizing a PEO in terms of documenting payroll tax differences with the IRS. The great news is the Act actually has been very helpful, at least to this point, in many situations at mentioning PEOs. For instance, there is a hold harmless for PEOs with specific forgiveness and use of proceeds if this goes on to a loan, a longer term loan of 10 years and interest and so forth. They are recognizing the distinction between the PEO and the site employer. We have seen no red flags that have come to our attention that the government at this point is intending to cause any headache or heartache to those that use PEOs. The PEO is a very large industry in this country, and the purpose of this is to help the site employers, the small businesses, have these benefits passed through to them. And the Act, the way it's drafted, gives the correct indication that is what they're doing. And having been involved at the national level with Carlos Rodriguez, we are getting the same feedback in the PEO industry that the government is aware of these relationships and it's intended to directly benefit the site employers and pass this through. We are hoping and believe that there will be more guidance, but we have not seen anything that would cause any indigestion at this point. Okay. The other question is regarding any expected additional guidance on the economic necessity certification. Very, very good question. We had looked into this issue before yesterday and very little guidance, but my understanding is on the economic necessity certification, you'll be seeing more guidance coming out in the coming days. You are not, according to the Act, and I assume what you're talking about here is whether or not you have to prove your numbers have fallen. You have received and you've lost contracts, you've lost receivables and all that. There is nothing in the Act that requires that in terms of you providing that documentation to the government in order to receive these loans. They are asking you for a certification that we spoke about in the webinar, but it's meant to be, there's going to be a lot of good faith here, but I do think it's a good practice to keep your economic necessity certificate, your economic necessity background info in your pocket, such as a decrease in your business, delay in payment from your vendors and so forth. But clearly this is meant to help those companies to survive and retain their employees and their payroll during this period of time. There is not a litmus test in the Act that they're asking you to abide by, but they are asking you to work in good faith. As a good business practice, it makes sense to keep your backup documentation in order if you ever had to. We are not aware of any look on a pre-crisis revenue versus a post-crisis revenue. Not aware of any formula or litmus test. What the Act does say is after the 8-week period, they will look at whether or not the qualified business that provides that certification that obviously this is a crisis and they need this for purposes of maintaining their payroll and so forth. They are going to be looking more post the 8-week period on whether or not it's forgivable. And if you used it for those purposes, and if it is, the greater the forgiveness. If it's not, the less the forgiveness. But there is no provision in the Act that there is going to be this type of oversight that we're aware of at this point as to how your revenues were before and how your revenues were post-crisis. I think the goal is to give these small businesses the opportunity to retain in light of the difficulty that's out there. And a lot of these certifications are on good faith. The guidance may provide more requirements. We have not seen those yet, but at this point, the best practices to track your business development, track your receivables in case there's more requirements. But at this point, nothing in the act that would be the kind of oversight that this question is asking, but a very, very good question. As it relates to independent contractors, does it matter if we issue the 1099 to a person or a business? We had answered this earlier. This issue has come up. There is no guidance in the act as to whether between an individual and a business. What it does say is that for purposes of calculating payroll costs, the contract, the 1099s are part of that. The question that'll be key is whether or not the business will be able to include it in the calculation of its loan, or whether it will have to, or the 1099 will have to do it on their own. It appears as if some banks are, as I told you earlier, are asking for documentation to include the 1099s as part of the loan application. Having said that, in light of the fact that there is traffic out there between between those that are being affected by this, as that there's confusion and clarity as to who applies for it on the 1099, you'll probably see more guidance. But as you could see, banks and many of them, the mainstream, are looking at this as businesses are incorporating that as part of their payroll costs, but that remains to be seen. Okay, I have applied for SBA EIDL along with $10,000 advance payable regardless of loan and the Florida bridge loan. If I can get the PPA and the SBA loans get approved in a month or so, can I no longer take the SBA loan for expenses outside the 8-week PPP period because recovery may take longer for any business? Very, very good question. Your respective loan has its own terms. What we have out there in this act is that there are specific qualified loans that are used for similar purposes that can be rolled into this loan forgiveness program. In addition, we spoke about this earlier. Carlos has read some authorities that are coming out on the EIDL. Best practice here is speak to your CPA, speak to your financial consultant, and your consultants review your loan documents to see if ultimately with the guidance that's forthcoming, your specific loan will be rolled into this loan forgiveness program or not. But if it's rolled into this loan forgiveness program, there is nothing in the act that would alter the use of these proceeds beyond the 8 weeks. What would be interesting to see is how this would, if it's rolled in, how would it impact the terms of your existing loan? And it would be, and I think there's going to be more guidance coming out from the SBA on that. That is the hope, because this is a common question. Those that have these existing loans or in the middle of an application, the goal is to get them rolled over and get some of these benefits. But it needs to be analyzed on a case-by-case basis with your consultants, your tax, accounting, and your legal consultants to review the terms of the loan to see if they actually can qualify and be rolled in, and what's the impact of being rolled in. What if you're planning to bring on to your staff someone, and that person is no longer at his previous employer, and I'm not in a position to hire the individual? Can he get on my payroll? It's a very unique situation. In other words, is he now in limbo? Okay, very good question. Now, when we went through the analysis earlier, remember, for the forgiveness, you are allowed to hire during this period of time. In fact, that's encouraged. What's going to be key is that you can use it for payroll cost. The law, the act does not say that you can only use those proceeds for payroll costs for those employees that existed prior to the loan. You could use your payroll costs for employees during the 8-week period, including those that you hire. What's going to be key is that you take the average full-time equivalent employee fraction that we talked about earlier during the relevant periods. Remember that the numerator will be how many full-time equivalent employees did you have during the 8-week period. It'll be divided by the average number per month on the numerator and denominator of full-time equivalent employees during the choice period that you select. They're not saying you have to have the same exact employees. What they're saying, it's more based on the number of employees and whether or not you're keeping them employed. Adding is helpful, but it's an average over a period of time. Okay. If you have furloughed employees, can or should I bring them back to full-time wages even though I don't need them at work, thus keeping them off unemployment? I will turn this over to Kelly, as that was part of the second half of the presentation.
So this is one of those questions that it's got to have the input of all of the team. It's got to have the input of your tax and accounting professionals, as well as your legal counsel, because some of the things that you are going to want, presumably you're asking the question, and I don't want to assume, but presumably you're asking the question because of not just the unemployment piece, which is fine. Keep in mind that there is a reemployment. Florida specifically has reemployment rights for furloughed workers, so you can send them there if you're asking that as a standalone question. Florida's got its own work sharing type situation for employees who are underemployed. But with respect to calculating the wages that you're paying as part of doing the calculation for your loan amount, that's where you're going to want to talk to all of the different professionals to figure out what makes more sense for your business for an overall perspective. I'm not sure if I'm answering your question because there's so many different pieces for that. So Carlos, did you have anything else to add there? Because I think we're asking about a bunch of different aspects of it.
There is, yeah. You know, I agree with Kelly that the furlough and the unemployment insurance and the numbers there are very, very important. One big thing to think about, there is no prohibition on bringing back employees to the business. The goal from this loan forgiveness program is that you bring them back and you keep them during this 8-week period to be able to use these monies to pay them their full salaries. The key is retaining employees as part of getting through the coronavirus. So I agree with Kelly that you need to talk about whether or not the company can sustain this. There are other implications as a business for having full staff. There are other expenses associated with that don't qualify for the forgiveness of loan. But if you're able, and this is a decision that your financial consultants can work with you very closely, if you're able to bring them back onto the company and use these proceeds to keep them, the goal is that when you emerge out of this virus, hopefully it gets beyond the next 2 months. But the goal of the government is that when you emerge, you can continue to employ them and keep them on payroll. If you keep them furloughed and you put them on unemployment, of course, that will have an impact on your formulas, because as you look at the formulas and the amount of loans that you get, the forgiveness component, take a look at that fraction when you analyze the numbers with your financial consultant. Remember the fraction about the number of employees you have, as well as reduction in pay. That formula will be very, very key in determining whether or not you're able and you're capable of bringing on all of these employees back and participating in the loan forgiveness program. But to answer your question, aside from Kelly's portion, which deals with the expanded unemployment, the benefits directly to these furloughed employees, which are a big part of the CARES Act, and they're going to benefit directly from the expanded unemployment and the amounts that they receive, there is not a prohibition of bringing these furloughed employees that you just furloughed back. In fact, it's encouraged. The question you have to decide is, based on that forgiveness fraction that we talked about earlier, how does that impact you in the next 8 weeks and beyond, when the administrator bank is going to be assessing forgiveness and so forth? If you're one of those companies that can survive this time, this could be a good opportunity when you work the numbers, but best to confirm with your financial consultants and accounting consultants. But there's no prohibition. And I agree that you should look at this holistically. These employees, if they are furloughed or terminated, may have other benefits, but from a business standpoint, you may very well have a reason to keep them. Just check the numbers and crunch the numbers on a case-by-case basis. Okay, how do you calculate full-time employees for 1099 entities? Okay, you are not, if you are a business and you are applying, the purpose of the 1099 is to come up with an overall loan amount number, and whether or not that 1099 will be included in payroll costs for purposes of calculating the number. Also, that payroll cost definition will carry over as one of the 4 components for forgiveness. Here, assume, despite the confusion that's out there, that the banks go forward and say, I need your 1099, I need the 1099 entity or individual that we are accepting to be included as part of the loan amount. They are not asking you to go into the business operations of that individual or that entity. They are simply asking you for an amount no greater than $100,000. So for purposes of FTE for 1099 entities, that's a separate application. That the full-time employee is not a contractor, that's an employee. The 1099 is more used in the act for purposes of determining the loan and determining forgiveness, assuming that what many out there believe is that the contractors will be added in calculating the overall loan amount, as well as use of the proceeds for forgiveness purposes, assuming that's true after this confusion gets determined. But the 1099s, full-time employees are separate. 1099s are for contractors. Full-time employees are your W-2 employees, and your CPA and your accountant can assist you for purposes of doing that. But if you're a 1099, if you have a 1099 entity or individual, you are not, according to the Act, needed to delve into their internal full-time employees. So if you have a business that's a contractor of your business, and ultimately they are allowed to be part of your loan amounts that you calculate, they're not asking you to delve into that business. That 1099 stands on its own, and the cap on the loan amount is an annualized compensation of $100,000. Okay. We had one business which began November 2019 with 100 employees. How would we calculate the loan amount? Okay, so the banks are not looking back at 2019 for purposes of the loan amount. What they're asking you to do is to come up with a loan amount based on the definition of payroll cost, which is your payroll cost that you have currently. So if you started in 2019, that's great. You qualify there because the covered period is that you need to be a business as of February 15th. So that's great. So you're there. But when you calculate the payroll cost, it's the payroll cost as of when you make the application in terms of the various categories and so forth. What are your current payroll costs? What are your numbers there and so forth for purposes of, and it's got a definition in there. And so the banks will give you all that you need. What's important is that you existed on February 15th as a business. And then when you calculate your payroll costs, get those numbers in order for when you make the application. If you're going to be bringing back employees, that's going to be included as part of your loan application for purposes of getting that done. Now, the payroll cost, when you do that, remember, it's payroll cost, it's the monthly, but it's based on, let me clarify what I said earlier, it's based on the average over the past year. So if you have less than a year, you still do the average based on the amount of months during that past year. You just had to be a business on February 15th. So I clarified that it's the average monthly that you calculate today based on the payroll cost numbers for the past year, but you had to be in existence as of February 15th of this year. So if you only started in November of 2019, it doesn't matter that during the past year you weren't active for the whole year. What matters is that you were active on February 15th and you go back for the year before, and it's not the current payroll cost, it's the average monthly payroll cost for the past year. And if you only were in existence for 7 months, you're going to average it based on those 7 months or 5 months, but at least the operative date for you is that you operated as of February 15th. So I'm glad I clarified that. That should answer your question. I think the question now that I read it is if you existed for less than a year from the amount you take your loan, are you prohibited from taking out a loan? The answer is no. You can still do a loan as long as you were in existence on February 15th of 2020. Okay. Question similar to above. We had a business begin operating January 5th with about 60 employees. How would you calculate the loan amount? Same answer. What they're asking you to do is to take the average monthly payroll cost for the previous year, beginning from the date you apply, you get the loan, the date of the loan, say it's April 15th, backwards for the previous year. It doesn't mean you have to have all 12 months in operation. You just had to have been operating as of February 15th. Now, great question. You may have different number of employees that you had throughout each month. That's why you take the average. It's okay that during the prior months you fluctuated, but you take the average number. Okay. Are church employees who are normally excluded from SUTA, FUTA non-eligible? There is no prohibition, I believe, on nonprofits and so forth on this. So, and the only part of that can be included in determining the loan amount is the SUTA, not the FUTA. So if they're a nonprofit, check with your legal counsel, your CPA, as to what form of entity you are. But there are specific provisions that deal with nonprofits and charities. Did the government or SBA provide any information on the employer FICA portion of employee wages? Yes, under the Act, when they define in calculating the loan amount, when they define the payroll cost, FICA is specifically excluded. It's limited to state or local costs when you're dealing with that portion. And you'll see the definition. It's very clear. You know, the premiums on the health, retirement benefits it talks about there. Now, the employer portion of what they're paying. So in the end, it's very specific, but the federal taxes are excluded. The state and local taxes are included should there be any. And of course, there are in Florida, there's state taxes there. If employees make $150,000 in salary, is the $100,000 included in the potential loan amount of the PPA, or are they excluded altogether? No, they if an employee makes $150,000, they are included, but it's capped as if you annualize them at $100,000. So the additional $50,000 is not included in the total compensation for purposes of calculating the loan amount. Can a business apply for an emergency bridge loan on SBA, or must it be just one? As discussed earlier, there are specific loans that can potentially be rolled into this. Check the loan term, the loan documents, the type of loan with your CPA financial advisor. Will payroll be considered in the loan for someone who was hired and is scheduled to start within next week? That is their payroll is not reflected at the time of the loan application, but will be incurred within 1 week from the loan application date. The definition is very clear on this. It is 1 year, the average monthly payroll cost from 1 year prior to the loan. So if you start them now, and you don't get the loan until May 1st, or you don't get the loan until April 30th, that's included as part of payroll. That's included as part of determining the average monthly. But if they are hired after the loan, then no, you've already got your loan, and therefore they would be used more for determining the formula on forgiveness, but not for purposes of calculating the loan amount. It's the 1 year period prior to the loan. Okay. As a restaurant, we don't have the hours to keep them at even reduced hours. If we use the paycheck protection and we pay them, do they have to work the hours being paid? The government wants you to retain these employees. So in the end, if you can keep them employed, that's what they want. They want them to receive these and spend it. There's not a provision in the Act that says if you don't have enough business, you must fire them. No, the Act says keep them employed and keep them paid. So as long as you earmark it to pay them, then you can keep them in accordance with the Act. You don't need to, if you don't have enough work for them, they can still stay on payroll. If you have a $100,000 loan and reduce salary by 25%, and I pay out $75,000 to salary, will the full $100,000 be forgiven, or only the $75,000? Okay. And this I reduce. Okay, so when you reduce salary by 25, there's two categories here: reduction on staff and reduction on salary and wages. Assuming you don't reduce your staff, so that fractional analysis goes away, and you're only talking about reduction of salary. For those that in 2019 made less than $100,000, you reduce the forgiveness only for those employees that you reduced by more than 25%. So the first 25% reduction does not reduce your forgiveness. Question that came in via internet. Okay. Can you clarify again, what if you've already submitted an IBL SBA loan, and what if you've already released some of your employees? Great question. We've discussed that earlier. Carlos Rodriguez has a nice memo that came out, and this deals with whether or not it will exclude you from the loan forgiveness programs and whether or not it'll be rolled into. Check with your financial advisors. It's possible that they will be rolled into and may not make you ineligible, depending on the type of loan, the terms, and the guidance that's coming out in the coming days. What if you've already released some of your employees? Government loves for you to rehire them. If you can rehire them, great. Just use the proceeds is the optimal scenario to get the 100% loan forgiveness, and that you, as much as you can, the purpose is to retain them and to use these proceeds to retain them during these trying times and during that 8-week period, so that you can get the maximum loan forgiveness. Since we are under quarantine, would we not be able to claim 80 hours for everyone? No, that goes back to the first two webinars and Kelly's presentation. There are specific reasons to be able to get paid sick leave, and I'll turn that over to Kelly.
I was muted. I muted myself. So since we are under quarantine, would we not be able to claim 80 hours for everyone? I'm sorry, I'm having trouble understanding the question. The emergency paid sick leave sets forth the criteria for providing the emergency paid sick leave to the employees. If they are unable to work for specific reasons, then they are eligible for these 80 hours of the paid leave. Being under quarantine is, I believe, one of the reasons. I'm sorry, the law changes so many times that I want to make sure I get it right for you. So I'll come back to that at the end if you don't mind. But would we not be able to? Yeah, for every
also not, if you are working, the employee, and if you are quarantined and you're working right now, essential businesses are able to work. If you are working for your business, and you're able to work, then of course there's no double dipping here and so forth when it comes to that.
Right.
Yeah, and when you're talking about a quarantine, go ahead, Kelly. I'm sorry.
Yeah, no, that's okay. So there's two aspects here. One is the business is closed because it's not an essential business. The other one is that, there's a quarantine that's in place based on a medical provider's recommendation. And so the eligibility there would be for the employee who is unable to work because the business is closed. Because the employee themselves are under quarantine because the medical provider, so they are able to claim this 80 hours of emergency paid sick leave because presumably they're not able to work from home, as Carlos mentioned. Now, if they are at home because the business is closed pursuant to this non-essential business in a municipality or a county or what have you, and there are other reasons, such as they're taking care of a child, so they can't work from home. The place of business is closed, and they can't work from home. And they are taking care of a child whose school is closed, for example, they would be entitled to the 80 hours of the emergency paid sick leave as well. So, to the extent the employees are eligible to receive it, it needs to be paid, and it's credited against that Social Security tax that the employer would ordinarily pay.
Yep, the actual reasons for taking leave is inability to, when you're unable to work, the reasons for taking leave are detailed specifically in our prior memo, and those reasons have not changed. The key here is whether or not you're operating as a business too. The business will have to make a few decisions. Is if it's closing its shop for purposes of the quarantine, is it still paying its employees? Obviously, if you're still paying your employees, you don't need to double dip and even worry about the paid sick leave. If you're not paying your employees, then you need to go into one of those several reasons to see if you qualify under that. You could be an essential business, you're working, and so forth. You could be you could be furloughed. You could be on it. The company could take a whole different approach. If it's just shutting down, then it's shutting down. If everybody is at home and not working, you got to ask yourself the first question is everybody still getting paid? Because if everybody is still getting paid, then there is no analysis of a paid sick leave because they're getting their full salary anyways. If they qualify under one of those reasons, specific reasons that are very detailed, then the purpose is that the paid sick leave be paid and that the purpose from these programs is 100% reimbursed to the company. So I think you have to look at it from a company standpoint as to whether or not there are any operations, number one, if there are operations. If there are no operations and they're still paying them, that's important. And if there are no operations, but they've got them on staff, are they under unemployment? If they're not under unemployment, but they've just, the employee claims it, the employee claims sick leave, then they have to fall within one of those 6 provisions, which are very coronavirus oriented, as well as school closure oriented.
And I'll also add that it's effective tomorrow. So anything up to this point is not covered. The emergency paid sick leave and the expanded FMLA take effect April 1st, which is tomorrow.
And if you participate in the loan forgiveness programs and the loans and you get money and you're paying these employees, there is no double dipping. They're receiving their full pay. So if they're receiving their full pay, then they can take leave, but in the end, there is no double dipping here. They're meant to not double dip. Yeah. So you get the purpose there is that the employees, of course, be retained and maintained as to where they're at now. Okay, moving on to the next question. If you are self-employed S Corp with no employees, is this loan applicable? The only person who is getting paid is the owner through a disbursement. Additionally, is unemployment available for this person? The answer to your question is, for the first part, is yes. If you're an S Corp, sole proprietorships, businesses, you are able to apply for the loan, even if you're the only person. What's going to be important is that you show payments historically for the loan amount, for payments to you and so forth, and the bank will likely ask you for the specific documentation. You take the average of the payments for the past year that fall under payroll costs, but there's a specific provision that sole proprietors, self-employed are permitted to up to $100,000 in pay. So if you're a sole owner, you've got your own business, and you're out there and you make $300,000, you're not going to get paid for the 300. You're only going to be paid on the average compensation over the past year in payroll costs for up to $100,000. That's for the loan amount. And then you have to apply it when you use those proceeds. The first amounts that are applied to that first 100,000 are the part that you calculate towards forgiveness. Forgiveness works the same way, by the way. If you use those proceeds and in the future and you pay beyond the annualized 100,000 to somebody who makes more than 100,000, you don't get the loan forgiveness for the amount above the annualized 100,000 in total compensation. That's an important point. Is unemployment available for this purpose? Kelly, I'll turn this over to you. But remember, if you're applying for the loan forgiveness and you're seeking these monies, you shouldn't be double dipping. But go ahead, Kelly.
Right. Nope. That's exactly what I was going to point out. I mean, it's in most cases, it's an either or. It's either the unemployment or the loan with the forgiveness. It's either the tax credits or the loan with the forgiveness. In terms of on its own, is this person eligible for unemployment? Yes, so long as they can show that they have a loss of wages or employment generally due to COVID-related reasons. So they're going to have to self-certify as to what their employment loss is, but the fact that they're self-employed S Corp is no longer going to be a bar to claiming unemployment.
Carlos?
Do we lose Carlos?
I think we may have lost Carlos.
Oh, can you hear me? I'm sorry.
Yeah,
I apologize. I was talking and it must have not gone on mute on time.
Now we hear you. Go ahead, Carlos.
There's no penalty for using the loan for the reasons explicitly in the act, except if you're using it. Obviously, I wouldn't use it for fraud or personal reasons. But the main thing the act focuses on is that if you use the loan proceeds for other reasons, you're going to lose the forgiveness. You have to use it for those 4 categories. And if the act says that if you don't use it for those categories, the interest, the utilities that we spoke about, the payroll cost, the interest on the mortgage, those 4 main categories that we spoke about earlier, then it converts into a 10-year loan with up to 4% interest. So I think the important thing here is that people do this in good faith. They're not committing wrongdoing. They're not committing fraud. But if they do it in good faith and they happen to use it for reasons beyond then you're going to lose the forgiveness, and but it is a non-recourse, no personal guarantee no personal guarantees from you all. I think you should just act in good faith. Try and earmark it for the 4 reasons. If you don't, just be prepared that you may have an extended loan with the government. Okay, can we send questions or can we ask directly? You can keep asked directly during this chat, and then any questions we have later on, we're available and Regis is available, and we'll deal with them there. Okay, there you go. Regis said please send them here. Okay. If I have grant funding that partially pays for salaries and rents, will this affect the forgivability of our PPA? As we've discussed earlier, important to check out the terms of those loans. Do they qualify? Are they specific? You can't double dip. Is that a federal program? Is that an SBA program? See what type of grants that you're dealing with, and the guidance should be coming out in the coming days. Sit down with your financial advisor, CPA, and legal consultant and see what the terms of that grant are, because what the government doesn't want to do, the government doesn't want you to double dip. So if you're approved for the forgivability of these loans, it's good at the beginning of the loan application to make it clear to the bank that you may have other loans or grant situations that need to be assessed as to whether or not they're going to be rolled into this or whether or not it would disqualify you. And before you go to the bank, speak to your consultants, your legal, accounting, and financial consultants. Each loan and grant has its own terms, and there's guidance that should be forthcoming. What if the bank starts getting complicated in the amount of information and paperwork required by the bank, even though the SBA may not be asking for it? Good question. I suspect that the federal side of this is going to crack down on banks who are going beyond. That's a possibility. Why? Mnuchin wants us to be as simple and as seamless as possible. They don't want the banks to overburden the actual small business. They want to make this quick and get the liquidity into the market as quick as we can. And as Carlos stated earlier, Saladrigas, some of the banks out there that there is some criticism out there that some banks may be overreaching, including the forecast of profits and so forth. So best thing to do is see what comes out in the guidance in the coming days. The ultimate objective at the federal level is that this be seamless and helpful. And they're trying to make the banks understand that and work this quickly. The banks are probably reacting a little aggressively in certain scenarios to protect themselves, but the government is saying just get this money out there. Regis is set up to provide loan forgiveness requirement information. Correct. I'll let Carlos Saladrigas, do you want to talk about that? I know some of this information is already in this webinar and available as needed, Carlos Saladrigas.
Absolutely. I'll answer it. I think I can answer this pretty quickly. We are definitely set up to provide the loan forgiveness requirement information as far as what we know today. Again, there's some talk that actually some of the requirements that the bank is asking for today to get the loan were actually meant to be for when the forgiveness came, not necessarily to get the money. I think the way the government's looking at this is, hey, we want to get the money in our clients' hands ASAP. We'll deal with any consequences when it comes time for forgiveness. So apparently, from what I'm looking at and understanding and talking to different people, a lot of what's being asked for is for the forgiveness, not necessarily for the loan application process. But we are waiting to see again from the guidelines of what comes out. But yes, as far as I know, anything that's out in public that I've seen that is payroll related or Regis related, we are ready to go and provide that information.
Great. Thank you, Carlos. If we receive PPP loan today, for example, and our covered period is the next 8 weeks, what if we don't have hours as we are operating in reduced capacity restaurants? Do we still need to hire enough to meet FTEs in order for loan forgiveness? Yes, in the sense that if you don't rehire, if you get a loan, you're going to give them the average over the last 12 months of your payroll cost. The purpose of this is to use it for retaining employees. If you take that loan and you just keep it and you don't use it and you don't have the number of employees of staff during the covered period, the full-time equivalent employees divided by the number of full-time per month, divided by the number of full-time equivalent employees during your per month, during your choice period that you choose, you're going to lose forgiveness. And that's a big incentive there for having you retain, rehire, and keep capacity. Good question. We have 2 real estate companies under common ownership, Company A and 50 independent contractors. Company B has, hold on one second, has 30 employees and 450 independent contractors. We plan on applying for 2 separate loans. Please confirm this is the right approach. Are we considered to be 500 employees since the 2 entities we are over 500 considering we have so many independent contractors? Great question. Excellent question. This goes to the analysis under the affiliation rules. Let me answer the first question. If in fact you have different locations, that does not apply to non-NAICS 72 companies, which NAICS 72 companies are hotels and restaurants. If you're not a hotel and you're not restaurants, then that location by location analysis goes away. If you are just talking about an overall company, if you're not in that category of hotels and restaurants, you are capped at that 500 employee minimum. The key here, 500 employee maximum, under 500 employee requirement rather. The key here is whether or not under the affiliation rules, do you go over that? So your legal counsel should go through in detail your corporate structure and determine whether or not you are that business concern that qualifies for being under 500 based on the applicability or non-applicability if you are a restaurant or hotel under 72, and see if the affiliation rules in any way cause you to be excluded from the minimum 500. So this is an analysis that your corporate structure, ownership, control issues, and all that be analyzed as to whether or not you are considered an under 500 business company. So a very, very good question. And also the applicability of your independent contractors comes into that. The employee, the less than 500 employee minimum requirement is for less than 500 employees. The independent contractor analysis is used in the act for purposes of calculating the loan amount. I think the key here is to determine whether or not there is common ownership control under the affiliation rules and the applicability of the affiliation rules to you. All right, going to the next question. How would I go about acquiring the exemption for FMLA for parents with kids who cannot go to school? We have less than 50 employees, and they would definitely cause us a going concern issue. Very good question. Kelly, I'll turn it over to you, but I know this issue came up with us yesterday, and there is still guidance that is pending. I assume what you're asking here is the exception under the expanded FMLA and the expanded paid sick leave for those companies that are less than 50 employees who have a hardship and can't get through this. Can you get accepted? The latest and greatest as of yesterday, us researching this issue, is I understand that there is supposed to be more guidance coming out of this as to how the government will make those exceptions. Kelly, I don't know if you have any other issue, anything to add. That's the latest I got as of yesterday.
Nope, that's the latest and greatest. That additional guidance is going to be coming out. But that what you can do in the meantime is prepare the documentation that you have to show how this would be a hardship on your business, to provide this leave to your employees. Specifically, this is obviously for the care of children, because there has been guidance that has come out already in terms of the emergency paid sick leave, where the exemption, there's a distinction made that this under 50 would not apply when it's for the employee's own health concerns, but rather the exemption would apply in the childcare setting, because presumably what the hardship is every one of our employees has children, and if we allow them to all take this leave at the same time, we have no employees to run the business. So that documentation is what you need to gather to be ready to submit once we get the guidance as to where and how that gets submitted to get the exemption.
Great. I'm going to go back to 2 quick questions. The one before For purposes of the affiliation rules, it's important. This is the question about whether or not you have 100 employees and 50 independent contractors, 30 employees and 450. Should you do 2 separate applications? The answer to that is be very careful. When you assess your affiliation rules, what they don't want to do is double dip. So if based on your affiliation, you are under 500, you want to do 1 application to avoid getting a double dip in terms of the proceeds. It makes it easier. So the analysis of the affiliation rules do apply for the under 500 in this situation, unless you're a restaurant or a hotel where the affiliation rules don't apply and you can possibly have less than 500 per location. But the affiliation rules may result in you not having to do 2 separate applications, but good to understand the corporate structure. One other supplement to a prior question that was asked about a local quarantine across the board in Miami-Dade County. Just to supplement Kelly's response, there is likely to be guidance coming out. A quarantine does not necessarily mean it's the same thing as a stay-at-home order. A quarantine is typically used, obviously, for situations in which the medical profession thinks that you should be quarantined to avoid the COVID-19 virus. We are hoping and expecting there to be some guidance on that now that the act is about to come out. But a stay-at-home order does not necessarily mean it's a quarantine, and we have looked through that and have not seen a distinction yet as to that. If we do find a distinction, we will provide that to Regis. Okay, going back to if we drew down on our existing working capital revolver as a precaution, would that loan be excluded if it was not used to cover payroll? Very, very good question, a very smart question. One of the things that we are recommending right now is that these loans that you receive, you are able to use your other capital. You are able to use your other loans that you have existing to pay, or that you receive, to pay for expenses of the operating business and so forth. The purpose though is that once you get the loan that's forgivable, use those proceeds. You can put it in a separate bank account, however you do, however you account for it, be very clear in accounting and use it during the 8-week period for those 4 categories in order to exclude it for purposes in order to make it forgivable rather. But you are allowed to use and draw down on your other bank accounts for other expenses that are outside of those 4 main categories that we talked about otherwise. In fact, it'd be very smart to do that. That loan, if it's used for other expenses, is part of your day-to-day ordinary business operations. It's a private loan. That's important to assess whether it's a private loan or an SBA loan. If it's an SBA loan, government loan, earmarked for these tough times, then it's important for purposes of that to assess whether or not it's disqualified. That whatever those loan terms are, whatever they may be, assess with your counsel and your advisors is whether or not it disqualifies you from participating. If it's rolled over or doesn't disqualify, great. But if you have an existing situation where you've been operating in good faith over the last several weeks and months, the government is not saying stop using your existing resources, your capital, your lines of credit and all that. That is there because you've had that before the crisis. You are dealing with that to deal with the crisis. Use the forgivable loan for those 4 categories. And if you're going to get a new loan, check with your counsel and get guidance as to whether or not that prohibits you from getting this loan. When calculating monthly payroll, is a fully loaded number burden or just employee salary? No, payroll cost. Good question. It's in the definition on this on the memo that accompanies this, and it's very well drafted also on this webinar. It's the average monthly payroll cost, not just salary. It's the health insurance premiums. It's the state and local tax component to it. There are very delineated components. It's all of that in one as your average monthly cost, not to exceed $100,000 total compensation per employee or contractor. Can we choose the date range for the 8-week period as long as it is between 2/15 and 6/30? I saw one of your slides that the 8-week period is between. Okay, no, don't confuse the two. The fraction is the 8-week period on the numerator, which is the 8-week period after your loan. The denominator are the 2 choice periods on the slide. The 2 choice periods you can choose from. That's not the 2 choice periods in the denominator is not the same as the 8-week period in the numerator. The 8-week period in the numerator is the covered period, which is the date of the loan forward 8 weeks. Okay. So, and as to that covered period, it's not any 8-week period between 2/15 and 6/30. It's the 8-week period during the covered period, which is from the date of your loan forward 8 weeks. Okay. maybe the confusion with the 215 to 630 is the covered period for purposes of the act itself as to when this applies. But the 8-week period that you're going to be presenting it is defined in this in the webinar presentation, and that's the definition that you use. If we have an existing credit line we haven't drawn on since early 2020, would we be able to obtain the PPL loan? Would interest be paid on the line be included as a cost for purposes of the PPL loan? Interest payments are included. Check the line item, the 4 categories, make sure it's included. But interest on mortgages and loans are supposed to be included. Check that they're qualified. But the existing line of credit, if it's existing, it's good to be used upon. It doesn't preclude you from getting a PPP loan by the mere fact that you have an existing line that you took out a while back. What might hurt you is if you take one of these other earmarked loans that are supposed to deal for the same purpose and you want to avoid a double dipping. Are other businesses eligible for the loan program if not in hospitality, real estate development? And is 401k included as retirement? Yes, if you're not, this is not limited to hospitality loans. It can be, it's under 500 unless there's any of these exceptions when you're dealing with category 72 for hotel hospitality and restaurants. Real estate development, there's no discrimination on industry practice for purposes of applying for the loan. What matters is that you actually you meet the eligible criteria and the number of employees, and that you move forward in accordance with its expectations and requirements. 401k included as retirement is included as to the employer portion that is paid by the employer, not the employee portion. We have been shut down, and that's included as part of the overall compensation under the definition of payroll cost. We have been shut down for 2 weeks as of today. Do I have to pay my employees today for the last 2 weeks in order to obtain the release when I obtain the PP? Do I have to pay my employees today for the last 2 weeks in order to obtain the release when I obtain the PPP loan? Or do I have to wait until I receive the loan to pay my employees? Well, if you hire your employees today, it's earned compensation. You need to pay them as employees under the FLSA rules that still apply. If once you get the loan, which is supposed to be expedited, you are to use those proceeds on a going forward basis for that 8-week period that you retain them. You are allowed to rehire them. If you hire them now and don't get the PPP loan for a while, you still have to pay them in the meantime. Under the standard FLSA rules, they can't be, you don't want to risk an earned compensation claim. What you use the proceeds for are the following 8 weeks. Okay. Can employee wages in accordance with the webinar?
Yeah, Carlos, that's only if they're working. If they're furloughed, you don't need to have them, if they're shut down and the employees are not doing any work, then you wouldn't need to pay them. But I just wanted to make that clarification there. It could be that they're furloughed. It could be a variety of ways in which you do not need to be paying them, but there are reasons for which you would be required to pay them. So just check with Regis, your Regis representative. They can escalate it to counsel if they need to in terms of making sure that you meet your obligations under the FLSA.
Excellent, Kelly. Can employees' wages be increased at any time during the 8 weeks and or beyond? Yeah, there is no prohibition. Hiring, expanding the business in terms of succeeding. The government wants you to succeed. What's important when you get the loan, at the time you get the loan, is that you certify the current situation in accordance with those 3 bullet points that we spoke about earlier. But if somebody does great, your business takes an upswing, you are allowed to increase compensation. For purposes of forgiveness, you remember the two formulas that we did earlier that could impact the forgivable amount. Just plug in those numbers and then it'll be, hopefully your numbers come out where you get 100% forgiveness, and if not, it'll be a fraction. But in the end, you can operate as an ordinary business. They're not micromanaging your ability to operate, but make sure your certifications when you take out the loan are in good faith. Are benefits paid on behalf of this employee, life insurance and disability insurance, in addition to health insurance, allowed to be included in the calculation for payroll costs? Our understanding is no, that it's the health insurance premium that the employer pays. Life insurance and disability insurance the understanding is not included for purposes of calculating the payroll. Obviously, check with your CPA to see if guidance comes out otherwise, but in a plain reading of the payroll costs, we did not see insurance and disability explicitly laid out in there. As a CPA firm, we are receiving many calls about servicing our clients' needs in order to streamline the approval process. A tip for our clients is to open a separate bank account, specifically for paying the costs covered by PP loan and or the SBA loan. This will ensure an audit trail that the loans are used properly and forgiven at the end of the term. Excellent advice. I think it's key. That's great advice. I think it's key that whatever you do, you track your money in and your money out, and you bucket it into those 4 categories, and that you have the backup for each of those 4 categories. Is my business still open? Am I able to apply? If my business is still open, am I able to apply for the PPP loan? You have to have been in existence as of February 15th, 2020. So yes, but you have to have been in existence as of February 15th, 2020. Should resignations or prior to on or before prior to February 15th, 2020, as stated in the presentation. Should resignations, retirements be excluded in the forgiveness formula? Very, very good question. There is a provision in the definition of costs that does include for termination and separation pay. So take a look at whether or not there is any termination or separation for determining the amount of the loan. As to the forgiveness formula, it's a strict interpretation that we've seen out there of what payroll costs are, which does include separation pay and termination pay per the definition of payroll costs. So as long as you use it in accordance with the original definition of payroll costs that is used for both determining the amount of the loan and the forgiveness component of the loan, that's what's being used for purposes of forgiveness. So take a look at whether or not a simple resignation without termination and separation pay doesn't add to the number formula on the amount of the loan or the forgiveness. You still go back to those fractions and those formulas that we have in the slide presentation. What is the penalty for using the loan for other not allowed reasons, dividend payments, etc.? As discussed earlier, what the government is saying is if you don't use this for what those 4 buckets, you're going to get non-forgiveness on that loan. It's not going to be forgivable. It's going to turn into a 10-year loan with up to 4%. And also, when you make your certifications, make sure you do them in good faith to avoid an issue. Are part-time employees' hours allowed in the calculation of FTE hours, fractional FTE amount? In terms of the forgiveness allocation, no. Those are full-time equivalent hours on the numerator and the denominator, assuming the definition, assuming how you define part-time hours that they're not full-time equivalent employees. That's in the forgivable component. That these specifics are there for a purpose. Now that definition, by the way, some of you may ask, what's a full-time equivalent employee? We have searched that already and are waiting for guidance on that. So I guess it's possible if the definition of your part-time employee falls within the guidance that's given there. But what the Act says is for forgiveness purposes, full-time equivalent personnel. As to the calculation of the loan amount, they are included. The temporary, you look at your overall payroll costs throughout the last 12 months, and you do that on an average monthly basis. So don't confuse part-time for purposes of the loan application for the amount and that with forgiveness. With forgiveness, we're hoping that they give us more guidance and definition on the full-time equivalent employee definition. But for that purposes, at least it looks like they're using the full-time term for purposes of the forgiveness component. Are the owners of the company who work the business as employees and receive a W, the payroll covered? Yes, but they're capped at, if they receive a W-2 in their payroll, and these are individuals that make more than 100,000, they're only capped on their annualized compensation up to 100,000, not beyond that. So owners can receive it, especially if they're W-2. Remember the issue we spoke about, that there's a conflict about contractors in K-1, whether or not there's a separate application or part of the application. Banks seem to be asking for 1099s and sole proprietor information, so that could potentially be lumped into one. But the guidance will clarify contractor situations in K-1s. But if they're W-2s, they work for the company and receive that they are covered. But remember the cap on the 100,000. Are out-of-state employees allowed in calculation? What they are looking for is United States employees. So if you are an out-of-state employee and you work for that business, there is no prohibition that we're aware of that would exclude you from being part of the calculation of the loan amount. So in the end, as long as you're working in the United States, that's what they're trying to foster. Keep the U.S. employees employed. For the payroll protection loan, did you say the cap for an employee's wages is 100,000? Yes. The cap, well, make it easier. The cap for the total compensation that's calculated is 100,000. So any and all employees making more than 100,000, we don't count the amount above 100,000. That is correct. The amount that you make in total, well, let me qualify that. The amount that you make in total compensation under the payroll cost definition, anything in excess of 100,000 is not included for purposes of the loan amount and for purposes of the forgiveness amount. We are a direct service agency for kids with autism. We technically are still working, but have about 1/3 of our caseload on hold by the request of the families. If we are reducing hours and or pay in the time being, will that disqualify our company? You are not disqualified because you are reducing hours. You are not disqualified for reduction in force. You are able to get a loan. They want you to rehire. They want you to retain. They want you to do that. Where this analysis comes in is the forgivable component. Once you get your loan, which is calculated on the average monthly payroll cost for the last 12 months prior to the loan, once you get that loan and then you apply in the future for forgiveness, they're going to ask you for the covered period analysis divided by the numerator denominator analysis. That might affect your forgiveness. So that's an important assessment to discuss with your CPA and your financial consultants and legal consultants as to whether or not this makes sense for you. If you are, but the goal is you are able, if you've reduced, they're saying hope's not lost. Rehire if you can. Keep your staff employed, but understand there's a forgivable component to it and an analysis that needs to be done. For clarity, in denominator for calculating the average number of employees, if you had less employees in last year's period than you do in this January, February, is it better to use last year's number? What you're going to do in the webinar, there is the fraction there. There are 2 dates. You choose the date that most benefits you to get the maximum amount of forgiveness. And the dates are laid out there. So what you want to do is work with your CPA and say, okay, my numerator, I know. The 8-week period, I got it. Choose the one below the denominator that's going to give you the maximum forgiveness, the amount that's going to give you the least amount of the fractional reduction. And that'll be done when you choose that. That'll be done directly with your CPA financial consultant to tell you which one is the best denominator. The good news is the government gave you 2 choices per the slide presentation, which is great. If I take advantage of PPP and keep all of my employees, I do not have enough work for all of them. Can I use them for other duties that are not part of their previous job description? For example, ask medical assistants to help with cleaning out, organizing, or store units. Absolutely, they want you to keep them employed. You can keep functioning as a business. All the other FLSA, FMLA laws still apply. So how you operate your business, check with Regis HR if you've got questions. Be careful with Title VII discrimination, disparate treatment, how you treat your employees. But the government is not saying don't put them to work if you've only got a certain aspect of work. Just do it in a legitimate, non-discriminatory manner. Regarding unemployment, are church employees eligible to claim unemployment under CARES Act when normally they are ineligible? We went ahead and discussed that earlier. There are specific benefits towards nonprofits. Check with your legal counsel to make sure that you qualify as one of those nonprofit entities and so forth. But the goal is that employees across the United States maintain employment. They're not trying to discriminate based on your charitable status, but check with your counsel. We are a Regis HR client. Will you provide us 940 and 940 information? For that, I defer to Regis. In the end there, as I told you earlier, what I could say is that the government recognizes this relationship and has done everything possible and is doing, it looks like they're working towards making this a seamless possibility between the PEO and the site employer. We're expecting more guidance. Obviously, we defer to the guidance, but I'll turn this over to Carlos if he's got anything to add there.
Yeah, I'll answer it as quickly as I can. Yes, what we've done in the past is when clients have asked us for 940, 941 information, is we have produced letters that we already have, a standardized letter that provides the 941, 940 information. These are issues that we've had either in the past with the IRS, a government entity, and again, it's never been an issue. Again, I can tell you that our association is working with the SBA, with the the government, to try to make sure that we understand as an industry what will be required for our clients. So we believe that a letter very similar to what we're providing today or have in the past is very similar to what will be accepted. But again, we're still waiting for what exactly they will want from us or from you as being part of a PEO. But I don't foresee an issue, as again, we are in the guidance, we are in the regulations and so forth. So I don't see an issue with that, but it's just a matter of exactly what they're going to want from us to be able to show your 940 and 941 information. We already have something standard. I've already sent it to a couple banks to get their feedback, and I'm waiting for that to see if they think that'll suffice. But again, we're just waiting for our association and SBA to tell us.
Okay. Thank you, Carlos. My son was working in Panama in Central America for a New York-based company as an independent contractor. He was in the process of looking for a new job when this occurred. Can he apply for unemployment? Well, unemployment and I'll let Kelly chime in on this. It's also most of our area, but I'll give you my 2 cents. Unemployment has historically been available, of course, for employees and so forth. It also depends on how he is set up as an independent contractor. Is he an employee of his own company, or is he just an individual independent contractor? If he's an individual independent contractor, there also needs to be assessed whether or not he qualifies for the forgiveness of loan, because he might qualify for the forgiveness of loan if he was in existence with that February 15th date that we spoke about earlier. So you need to look into that as to whether or not he qualifies for forgiveness of loan, as to whether unemployment has historically been used for employee-employer situations. And with that, I'll turn it over to Kelly.
Thanks, Carlos. Yeah, so the definition of eligible employee has expanded to include independent contractors. I'm unsure of the part about where he was working out of the country, whether that would put a restriction on there. As we have been stating over and over again, additional guidance has been coming out on an hourly, sometimes, if not daily basis. So the guidance that we've been giving our clients with respect to these unemployment questions is have your employees apply, simply because the administration of these regulations is going to be completely overwhelmed anyway. So get your application in there, and if you are rejected, you'll have an opportunity to provide corrective information if you can, and if not, you'll know that the exceptions that have been made under the CARES Act do not include this scenario. But in terms of independent contractor, yes, now you can apply. I don't know whether or not the fact that he was not working within the country would be a bar.
Great question. And I think the overall objective and the guidance that will be hopefully coming out will provide more direction. The key here is also, is this individual reporting revenue to the United States? Ultimately, what the Trump administration wants is to keep people employed, and that we keep revenue, we keep monies being spent in this country. So this foreign versus domestic type scenario and these details, we are hoping and expecting that there'll be guidance here coming in the coming days as to these subtleties that are coming out. The act is 880 pages, but it covers a lot. We suspect the guidance will cover more and hopefully have some hypotheticals. Going back to one other question, definition of full-time equivalent employee. Although not defined explicitly, there is an ACA definition for full-time equivalent that has a fractional component to it, but that has not been determined as to whether or not that will act as the definition under the forgiveness formula that we spoke about earlier. So and we are waiting to be seen if the guidance will give you the explicit definition. But there is other areas in the other areas of the government where they have defined full-time equivalent. The question will be, will they adopt the same here, which may include not necessarily a 40-hour-a-week perception that people think. So that remains to be seen. Good to keep your eyes open for that. Our payroll for last year was higher because we had another doctor working at our office. She left end of May. Can we exclude her for purposes of calculating the average payroll over the last year? As discussed earlier, the 12-month, no, if you get the loan after it's 1 year from the date of the loan backward, it's the average monthly payroll cost. So conceptually, it's possible for you to get the loan not in April, you get it in May. But I think in the end, if she's in that payroll for that 12-month period that you calculate backwards looking from the date of the loan, then that gets included in the numbers, and it's the average payroll cost during that 12-month period. So you have to see if she falls inside or out of that once you get the actual loan granted. Okay. If my business is open and I am able to obtain the PPP loan, if I use the PPP loan for payroll, will I be able to apply for the forgiveness of that portion used to pay payroll? Yes, if you're using it for payroll as defined for payroll costs, which includes paying the salaries, wages, compensation, they're encouraging you that to keep it for purposes of forgiveness. Remember, what they're going to do is go back and do that formula. So yes, subject to the formula, with the numerator being based on the 8-week period, the denominator being based on the choice period, and seeing if you fall into that. So use it for payroll purposes, etc. But you have to, that's good. That's the purpose of the forgiveness. But whether or not there's a reduction in forgiveness, that comes into the fractional analysis that we talked about in the webinar slide presentation earlier. Can I include employees not residing in the US in calculating the forgivable ratio? That the government wants you to keep employees employed. Those employees may be reporting in the US. They may not be reporting in the US, depending on the situation, but technically the US has this expectation of reporting in the US. So speak to your CPA, speak to your accountant. The guidance will come out in the coming days. The purpose of this is not to benefit foreign jurisdictions. It's to benefit US jurisdictions. So check with your CPA, financial consultants, once the guidance is fully fleshed out, to determine if there's any one specific employee residing in a foreign country and whether or not they're added in. Those are issues that we are hoping to come out in the coming days. I am paying all employees PTO until runs out. Can I reduce their 40-hour week to 30 hours thereafter to comply with the 25% reduction to still get full forgiveness? Yes, well, yes, subject to the formula. So there are two components in the formula. One is a reduction in staff, one is a reduction in pay. That doesn't tell you how you allocate your hours of work on a day-to-day basis. What they care about is what they're getting paid and whether or not you have had a reduction in staff compared to the periods lined out in that formula. So that's what's key. As to reduction in pay, if you reduce pay for that period for the comparable period of time that they're talking about, the full prior quarter, beyond 25%, that's when you start bringing down the forgivable number. But the first 25%, as permitted under that formula, is not going to reduce the forgivable amount. What is the, and remember, that is also capped at the 100,000. So for purposes of that, that only applies if you in 2019 were making less than the $100,000 mark. If you were making more than the $100,000 mark, that's excluded from that formula. What is the definition of an eligible business that would qualify to apply for the forgiveness of the PPP loan? The act is very lengthy. Look at if you're under 500, subject to some of these exceptions that we spoke about that deal with restaurants and hospitality where you can have less than 500 in multiple locations potentially. The memo that we give you a more expansive definition. The purpose of being an eligible business here, if you're a run-of-the-mill business, not in one of those accepted categories, is that you're less than 500 and operating. They're not discriminating in terms of whether or not you're in the cargo business versus the construction business. They are looking at this more from a numbers basis and a staffing basis as opposed to a type of business. Some types of business and seasonal employees do get other provisions applicable to them that you need to check as to whether or not you fall in that. But the run-of-the-mill, less than 500, if you're less than 500, look at the loan forgiveness program to flesh out any issues that may apply to you. With that, it looks like we have gone through all of the questions. Be glad to answer more, but I want to thank Carlos Rodriguez again, the Regis HR team, and all of you for your great questions. Best advice I can tell you is seek accounting, financial, legal counsel. Check with HR as appropriate. Look out for in the coming days for all the guidance and clarifications that are coming out. Thank you, Carlos Rodriguez. We're honored to have done this presentation. We wish you all the very best, and I'm going to turn it back to Carlos Rodriguez.
Thank you, Carlos and Kelly. I know we've gone way above and beyond the 1 hour that we set up aside, but I think it was important to answer everybody's question. Again, Regis, your team, HR is always available. I am available 24/7. Please feel free to text or call me. We'll continue. I promise you to stay on top of this as best as we can. We've got every resource that we know and can on top of this. Again, thank you all for your time. I know we're all going through a lot, but hopefully, most importantly, you and your families are all safe and continue to remain safe. And we hope to pray that we one day get back to normal. Again, thank you all. Thank you, Carlos and Kelly, for an outstanding presentation and for taking the time to answer every single question. Thank you all.
Very welcome. Thank you.